And this is how we have calculated our intrinsic value of the company and learned how to instantly get a lot of data using Google Finance. Isn't it awesome? Welcome to Chapter 3 on our How to Build Our Friendly Value Robot Investing App series. In the last episode, we went through the discounted cash flow method and its core concepts. Our final goal was to learn how to calculate the intrinsic value of a company and understand how discounted future cash flows of that company will help us towards that goal. If you haven't checked that video, be sure to watch it so you understand the logic behind these formulas. In today's episode, we will start by learning about the Google Finance function we can take advantage from. It will help us get a lot of historical and live data directly into our template. From this functionality, we will be able to build awesome real live time graphs. Afterwards, we will start from our discounted cash flow theory seen in the past video and translate them into Google Sheets formulas. Our template will help us calculate the intrinsic value of any company based on our assumptions much faster. Let's start with the first learning of today's episode: the Google Finance function. The Google Finance feature is a powerful tool inside Google Sheets. It lets you get up-to-the-minute and historical financial data for stocks, currencies, and other assets. You can pull a lot of different information, from a company's current price to a full year of its trading volume. The core of the feature is a simple formula. Same as other formulas we might be familiar with in Excel like if or VLOOKUP. Let's look at a basic example. By writing Google Finance function, followed by the stocks ticker, and ending with the metric we want to obtain, we can see real live data of the stock's price. But this is too much theory. I want you to open a new Google Sheet and let's try it out together. Pause the video until you are ready to do it at the same time. Don't worry, I'll wait. Are you ready? So, as we explained earlier, we start by typing the Google Finance function. You can click tabs to auto-complete it. After, you follow it by introducing the ticker for the company you want to retrieve the data from. In this example, Google. To finish, you bring in the metric you want to obtain. We will start by using a simple one as the current price. There you have it. Current Google stock price is $235. Easy. A little bit later, I will share more tricks to apply while using Google Finance. Soon you will realize there are a lot of metrics and data points you can get from this same function. Awesome. Now moving on to the second learning of today's episode: the DCF formulas translated into Google Sheets formulas. In the previous episode, we learned that the goal of the discounted cash flow method is to get to an intrinsic value. The intrinsic value was the sum of the discounted future cash flows and the terminal value. So let's go to Google Sheets and see how these formulas will look like. Here we are. Ready to rock some easy formulas? In this video, we will only cover the part of the template focused on free cash flow and intrinsic value calculation. That way we ensure formulas are understood before covering the full template. We start by preparing our working template with latest reported full year. In Google's case, it's 2024. Since we are working with a 5-year analysis template, we introduce next 5 years in the same row. The 6th year will be used to calculate the terminal value, so we indicate it in the top so we don't mix them. We are done laying the layout for the different years. Now let's continue setting the template with the rest of concepts we learned about. Annual growth rate expected for the next years. Discount rate we will set based on the return and risk. And the perpetual growth we assume this company will have forever. Careful with units. Don't forget to define the units in which you are going to show numbers. It can lead to big consequences. We are going to assume for now this company will grow annually 20% at a constant rate during the next years, and set a discount rate of 10% based on our desired return and risk assessment. Last, we put a 3% perpetuity growth to go in par with the historical US economy growth. Please remember, these rates are not fixed and should be adjusted. Check the stock analysis videos, see how you can adapt your approach. Now that we have our growth rate assumption, we can forecast our future free cash flows based on the latest reported one. The formula would be the latest free cash flow in cell B5 times 1 plus the growth rate in cell J5. Since the growth rate value is always in cell J5, we click F4 in your keyboard or place $signs. The formula will always point to that same cell. And there we have it. Now we can drag the formula for the rest of the years so that each year is growing based on previous year's free cash flow. The terminal value calculation is very similar, although it has also the perpetuity growth and discount rate into account. The formula would be also starting from previous year in cell G5 and multiply it by 1 plus the growth rate. But for the terminal value free cash flow, we are going to divide it by the discount rate minus the perpetuity growth. You can fix or not the cells, but I like to do it to keep this tidy in case I paste the formula elsewhere. Great! We have all required future free cash flows for our calculations. Although, we need to discount them into present value to know how much they would be worth today. As seen in the last video, we would need to sum the discounted values for future cash flows and the terminal value. So let's calculate them. The formula for calculating present value of the 5-year horizon is a little bit strange in Google Sheets and Excel. But bear with me and we will do it together. Open the formula and select the immediate year. Then, sum it to the net present value function. The first term of the formula would be the discount rate. So go ahead and select J6. For the second term of the function, select the following 4 years. In our case, until 2029. All done. Now let's go with the terminal value. For the discounted terminal value, the formula would be the free cash flow at terminal value calculated previously, divided by 1 plus the discount rate you have selected. Remember, you can use F4 or $ to block the formula in case you reuse it. That, to the power of the number of years in our horizon. In our case 5. You can also write what year into the future it represents and point to that cell. In this case is not mandatory. It is good to learn other approaches to writing formulas in Google Sheets. Let's get the decimals out of the cell to keep it tidy. Much better and easy to understand. We have arrived to our last stop. Now we will calculate the intrinsic value by summing the present value of future cash flows and the present value of the terminal value. Just add both terms. And that is it. You now know the intrinsic value of that company based on the future cash flows you are estimating for next year's. Let's do a real example with Google now. Last year's free cash flow was around $73 billion of US dollars. All future cash flow for next year's are now updated based on that number and the growth rate. For the terminal value, we are looking at the 3 parameters set also at the right of our template. Both present value for our horizon of 5 years and terminal value have been recalculated with the new value. Therefore, we have the new intrinsic value instantly. Remember that Google Finance function? Let's put it to the test. We will search for Google's market capitalization. Use the Google Finance function. Introduce the Google's ticker and type market cap to see the most recent data. In just a few seconds, you can have access to the stock exchange information. Remember about units? This number is in dollars, but we have calculated intrinsic value in billions. Divide it by 10 to the 9th power to see the market capitalization in billions of US dollars. Now, we can calculate the index ratio. This will tell us if the company is properly valued based on our assumptions. Divide the intrinsic value by the market cap. We can see the result is below 1, which means that this stock is overvalued taking into account our parameters. Of course, we can play around with different parameterization to obtain a different intrinsic value and therefore a different index ratio. Let's see what happens with a lower growth rate. Logically, the intrinsic value decreases and now the stock seems to be even more overvalued. With a higher growth rate, we get the opposite results and we could be at a good opportunity. See the index ratio at 1.33? Assume we now want a higher rate of return or adjust discount rate based on risk perceived from that company. We can see the intrinsic value decreases to 0.73. If we assume the perpetuity growth decreases, so will the intrinsic value. The purpose of this video and method is not to obtain the result you want by playing around with the variables until you get it, but to understand the levers you can adjust based on assumptions and the effect it has on the intrinsic value. In the next episode, we will start a template from scratch and explain what other KPIs or metrics we can use to determine how reliable our estimated cash flow can be and the quality of the business we are analyzing. Please like and subscribe and do not hesitate to comment. Your friendly value robot is out of battery. See you in the next one.